Okay, so meanwhile, just a quick intro. I'm Ian Bhattacharya, CEO and founder of Spurt, and we work with disruptive B2B SaaS and tech companies to help them scale revenue, reposition value, and optimize their pricing strategies. Over the past 3 years, we've helped over 15 SaaS businesses globally across fintech, edtech, compliance software, job management, and social fundraising platforms to achieve significant improvements in their MRR, LTV to CAC ratios, taking them from an NDR of sub 100 to over 120, whilst elevating sales efficiency, moving them up market, and successful expansion into new geographic segments. Prior to this, my pricing background spans across 16 years of working with companies such as TradeMe, Hoyts, News Corporation, Equifax, Westpac, and British Airways. Fantastic. Okay, let's kick off. Okay, so what we're going to cover today is we'll take a brief look at the SaaS landscape and trends and the impact on your growth strategy. I will show you various ineffective approaches to pricing versus more structured scientific approaches that successful companies adopt. I will then illustrate this with a real life example. So hopefully you can get an idea of what's possible with the right approach. We'll take a look at some of the data and insights that you need to collate before getting started. And we'll finish off with how you can leverage a value proposition canvas to perform a needs-based analysis. By the end of this, you should be clear on what the business needs to do before jumping into pricing and packaging projects, and what data and insights will help you to get started, so you're not starting from ground zero. Just going to try to change this so that's okay. Hopefully that's full screen. Okay, so what we've seen in terms of trends is that as the SaaS market has become increasingly more saturated with many players all competing for customers' attention, that CAC has significantly increased by nearly 70% over a 5-year period. This trend really speaks to the necessity of focusing on targeted acquisition based on your ideal customer profile, but also a shift in focus towards retention and expansion, not just acquisition at all costs. So one of the most common objections to price increases for businesses is a fear of losing customers. But how justified is this? Research shows that there is marginal resistance to price increases from 3% all the way up to 15%. The bars on the right-hand side indicate perceived success, and they represent customer negative reaction from 1 being severe to 5 being minimal. As you can see from the graph, the vast majority of SaaS companies are underpricing, and so increasing price simply captures some of this value and money being left on the table. It is important to note that pricing too low impacts how your potential customers value perceive the value of your product or service. If you're not getting any pushback on price, or at least from 25% of your prospects, then you're most likely underpricing. So let's take a look at what most companies are doing. This is the #1 approach that I see, particularly for early stage SaaS companies. The next one being cost plus an arbitrary margin, which is essentially the same as guessing. And then matching competitors, which is completely potluck, as you have no idea if your competitors have taken a scientific approach. More likely they're just guessing. Plus, your solution is not identical to theirs. Assuming it's better, you're leaving a ton of money on the table this way. Lastly, treating your customers as though they're all the same. Your customers obviously are not identical. They have different needs, preferences, and therefore willingness to pay. So all of this is essentially finger in the air. It's like just throwing darts at the dartboard blindfolded. So look, this is obviously a flawed approach. Your customers don't care about your costs. They're internal to you. And picking an arbitrary margin is as good as guessing. They don't even really care about your features. What they truly care about is benefits and value. When you are matching competitors, you're assuming that they've taken a value-based approach when in reality, they are most likely guessing themselves. Your customers are all different. And so therefore, this speaks to the importance of taking a segmented approach to understanding value. So this is what I recommend that successful companies take. We perform customer segmentation to understand exactly how value varies across the customer base. Product versioning essentially involves creating different versions of feature sets, which enables you to capture value from a wider range of customers based on the complexity of their needs and their use cases. And next, we want to balance the price value equation. Companies want to create value so that they can capture value. And typically your pricing, it should be based on willingness to pay, which reflects 10 to 20% of value. So that's the same as saying a 5 to 10 times ROI is a good rule of thumb for most businesses. So if we take a value-based approach, these are some of the outcomes that you can expect. You want to essentially align to your strategic objectives. That's very, very important. You essentially want to price in a way that enables scalable revenue. And so therefore, that improves customer success because your customers are going to be more satisfied if you understand what they value and are able to deliver that. And you have a range of different feature sets to be able to accommodate those needs. So in terms of, sales and marketing, you essentially, by pricing optimally, you will be able to attract your ideal customers. Those customers are most likely to pay you more and cost you less in terms of customer acquisition cost. In terms of people and culture, when you've got alignment around the value story, it's a better overall customer experience, and it's a better employee experience because you've got a lot less conflict between sales, marketing, finance, product, etc. We want to take the guesswork out of pricing with a scientific approach. So let's look at a real life example of how we did this at Biz Growth Spurt. Obviously, this is has been anonymized, so we'll just call them Company X, who are a social fundraising SaaS platform that were targeting enterprise not-for-profits. Now, they were in quite a difficult situation where their expansion revenue was declining. Their ARR was also going backwards quite fast, and they had a negative net retention revenue, which essentially means that they were losing more revenue through churn and downgrades than they were actually making through expansion and through net new revenue. So why was this the case? Essentially, they lost touch with customer needs. And therefore, there's a lack of product market fit. They lean too far towards being a sales-led organization, and they lost focus on product innovation. There was an internal bias around value perception, and they didn't have a scalable revenue model. And what I mean by that is they were offering all features to all customers, so there's no product versioning, and so therefore they had this outcome-based pricing model that was priced as a percentage of the outcome in a declining market, and so therefore their revenue was going backwards. There was no monitoring of competitors. And essentially, the competitors came in with more innovative features, with freemium propositions, and essentially started to eat away at their market share. The positioning was unclear, and they didn't articulate value well. So we worked together over a 4-month period, and the approach was essentially to identify exactly how their different customers identified value. And what we found was that actually a new product vision was needed. We collated the data on competitors and helped them to understand where they were differentiating. And so they were able to reposition to their ICP. We also helped them to identify what that ICP looked like. We also measured feature value with them through different surveys, pricing surveys, and helped them to repackage with a more scalable revenue model with essentially feature sets that catered to different customers with different varying complexity of needs. We helped them to actually build value models to actually quantify that value based on customer insights and data. And also, finally, we help them to actually test the willingness to pay through various experiments and things like conjoint analysis and Van Westendorp. So the outcome here really speaks for itself. Like the NRR went from being negative to 106 over roughly 8-month period. Their NRR went up, their ARR went up, their new business went up, and their upsells went up, and they were able to minimize their churn. So, hey, look, that's a lot of information to take in. So let's take a quick breather, and excuse the pun here, but we're going to do a quick exercise to see how much you would pay for air. Would anyone actually like to drop this in the chat, how much they would pay for air? There's no wrong answer here. Okay, let's push on. So I think what most of you would say is, look, in normal circumstances, air is abundant. It's all around us. You know, we probably wouldn't pay a premium for it. So we see it as a commodity. But what if we change the situation? So essentially, you're scuba diving. You've got a tank and it's running out of air, and you've got sharks circling above you, so you can't surface. In that situation, how much would you pay for air? I think most of you would probably say, well, my life depends on it, so I would pay anything I could afford. So the key takeaway here is the value that your customers place on your products or services varies significantly based on their use case and the complexity of their needs. Okay, so let's take a quick look at this model here, which essentially is the four levels of pricing power. Now, one of the major contributors to successful monetization is the level of pricing power that exists within an organization. Pricing power is defined as the company's ability to raise prices without losing customers or seeing a drop in demand. Or put another way, a company's ability to charge the price that it deserves for the value that it delivers. Pricing power essentially enables you to generate more revenue, which in turn drives greater profitability and cash flow, and is also one of the most important considerations when it comes to funding and valuations. In every market, we can identify 4 levels of pricing power: cost chaser, market pricer, value conqueror, and price optimizer. Now, we've talked about, cost plus pricing, and we've talked about matching your competitors. The most profitable, and we've talked about why those approaches are flawed, but the most profitable SaaS companies strive to become value conquerors and price optimizers, which essentially leverage internal data and customer research to establish willingness to pay and how that varies across the customer base. They also have more sophisticated customer segmentation, and value innovation drives their product growth and prioritizes their product roadmap. And they don't resort to discounts. They have a governance structure that helps to protect their margins. Price optimizers essentially are SaaS companies that will have incorporated everything from the previous levels, but they will have also implemented continuous price optimization processes, prices that vary by segment, and pricing engines that drive automation. And they will have adopted differentiated value selling as well, and leveraged tactics like behavioral economics. So, look, the main topic of this conversation is market research and analysis. But why? Essentially, we want to take the guesswork out of this. And so the best-in-class companies leverage both internal and external data and insights to make informed decisions around strategy. So let's take a look at some of the prerequisites that we need prior to getting started. Number one is we need to get clarity around strategic objectives. We'll cover more on this on the next slide. We want to understand usage data, which essentially indicates how your customers are, how they value different features and what their preferences are. Who are your best fit or ideal customers? These are the ones who essentially are likely to pay you more. And a good tip here is to look at your LTV CAC ratios and how they vary for different customers. You need to understand your cost structure, because essentially this is a baseline. You need to see that obviously if willingness to pay is below your cost to serve and your customer acquisition cost, then you don't have a viable business. Clearly, your willingness to pay needs to be far above that, so you have a decent margin. Now, you can get a lot of insights just by talking to your sales teams, around value and pricing, but watch out for internal bias. Competitor analysis. So we'll talk through this in a separate slide. Tracking discounts is useful to identify potential revenue leakage. And SaaS metrics is a very important way of understanding how effective your current pricing is and to help you to identify opportunities. NPS and CSAT scores insights also help you build up the picture around value and pricing. So look, pricing is a very powerful lever that helps you to achieve your business objectives. But there are a number of different objectives that you might see depending on where you are in the growth phase. What we often see at the early stage is SaaS companies are looking to just get as many customers as they can as fast as possible. It's a bit of a spray and pray approach, and not something that I recommend you do for very long. But depending on that, there are various pricing tactics such as penetration pricing. You can look at freemium and free trials. Price localization is obviously something that applies regardless of what your growth strategy is. If you want to maximize essentially B, C, and D are all about price optimization. You want to be looking at quantifying value, measuring value, etc. Here are some examples of companies that have done it really well. Like Slack, for example, they managed to grow very quickly through their freemium strategy. Apple, very well known for their premium pricing strategy, but also their product versioning. So having lots of different iPhones or variations of iPhones catering to different needs and different willingness to pay. Datadog are really well known for their usage-based pricing model. And of course, we know that Netflix have got a subscription model that has been very successful for them. So we really need to get clarity around strategic objectives as a starting point. And after that, we really want to get into analyzing pricing data. So wins and losses data, along with the reasons, will help you to identify any potential issues with your current pricing. Historical price changes helps you to understand, price sensitivity. You want to be looking at the impact that this is having on sales conversions, churn and expansion, where you've expansion. Pricing experiments help you to also measure the impact. Essentially, you want to be looking at case studies. You want to be putting together case studies and research that really help to message the value and the proof points around value. If you are easily winning customers, then you are most likely under pricing. You want to be essentially losing between 25 to 30% of deals, if you are pricing optimally. And then SaaS metrics that I also recommend that you monitor very closely are ARR, which is annual recurring revenue, NRR, which we spoke about earlier. LTV or CLTV is customer lifetime value. Customer acquisition cost, rule of 40, which is essentially your growth rate plus your EBIT margin. NPS and churn rates. These will give you, vital clues around the performance of your current pricing and packaging strategy. Okay, so the first thing we want to look at in terms of competitor analysis and market trends is to understand whether you're operating in a blue ocean or a red ocean. In the red ocean, you're surrounded by competitors who are all offering similar solutions, similar value, with little or no differentiation to stand out. If you're in the red ocean, then focus on carving out a niche so that you're not kind of in a spray and pray type situation. Good example of this is vertical SaaS companies. Or an alternative is focus on value creation to help you to shift to the blue ocean. Companies in the blue ocean tend to be price setters, whereas in the red ocean, they tend to be price takers. So we also want to look at market trends. You know, is your target market growing or shrinking? If your target market is going backwards, then you may need to look at potentially your chasm, crossing the chasm, looking at different sort of markets, different sort of customer segments, and then do a SWOT analysis to really understand what your point of difference is, what your strengths are, what the opportunities are, and then potentially where the weaknesses are and where you need to, you know, plug the gaps. Assess the competitive pricing and packaging models. So that's in terms of features and in terms of price points. How have these evolved over time? So Wayback Machine is a great way to look at that. And then, as we spoke about, key differentiators, which helps you, understanding these key differentiators helps you to put together this positioning statement. So next, we really want to define the customer problem and the benefits of this of the solution. Now, mapping out the jobs to be done and customer use cases is a powerful way to understand your customer's value chain and where to focus your product engineering, sales, and marketing efforts. Over a third of startups fail due to lack of product market fit, and we even saw this issue in the real life case study. Even if you did this at the go-to-market phase, it is worth validating that you have not lost it by checking in with customers regularly. So a simple way to do this is to survey your customers, and ideally at least 40% of them should respond to say that they would be very disappointed if your solution no longer existed. Understanding how you deliver value to your customers is essential to determining which pricing model is most effective within your SaaS business. Here's another really, good model. It's called the FAB model that helps you to transition your thinking from, functional features through to benefits and value. So taking like the example of a smartphone camera, that's essentially the feature. The advantage of that is, which is relating to the user themselves, is that it helps the user to take pictures. But the real benefit of that is you can take quality photos without needing to walk around with this bulky camera around your neck. So here's like a specific SaaS example. Let's just take a feature like product usage analytics. So from a user perspective, how does it make their life easier? Well, enables them to track user behavior and engagement in app. But the benefit, which is more closely aligned to the outcome, is actionable insights to improve product and drive adoption. So just to summarize, essentially you want to charge different prices to different customers rather than a one size fits all. You need to understand how that varies across your customer base and segment accordingly. You need to have product versioning, so a pricing and packaging architecture that essentially caters for a range in the complexity of needs across the target market. You should collect as much data and insights, both internally and externally as you can from that prerequisite slide that we discussed. So you're not starting from scratch, from ground zero. And then get clarity around the strategic objectives that you want your pricing strategy to help you achieve. I've seen some horrible cases of where, pricing strategies have been misaligned with strategic objectives, and it never ends well. Pricing cannot operate in a vacuum. It has to be aligned to sales strategies, marketing strategies, product strategies, customer success strategies. Very, very important. You need to understand your competitors' offerings and pricing in relation to yours. Please do not take your eye off the ball with this one. And you also need to understand your cost structure as a baseline to ensure that your pricing strategy is viable, or your business is viable, essentially. Next, you want to understand your ideal customers and create either an ICP or an ECP. ECP stands for early customer profile. If you're an early stage business, you want to try and do this as soon as possible, at least from a hypothesis perspective. You can then test and iterate that over time, and ensure you have product market fit within your niche or target market, and get clarity around the advantages and benefits and value that your customers gain from adopting features. So hopefully you've enjoyed that and you've got some value from today's webinar. The next webinar is on packaging and packaging strategy, and that is in a fortnight. But if you'd like to get started sooner, then feel free to get in touch via email or by dropping me a DM on LinkedIn. We'll now move to Q&A for the last 10 minutes. Please drop your questions into the chat and I'll try to answer as many of them as possible.